Hello everyone and welcome to Educate 247. Today we bring you the 16th lecture in the series on financial awareness, and this series is important for RBI Grade B as well as SEBI Grade A 2020 examination. Today we'll be talking about equalization levy for non-resident e-commerce firms. But before we begin, Educate 247 brings you SEBI Grade A 2020 crash course with around 5000 plus MCQs and concise content to help you cover the syllabus. To log on to the website and avail the benefits, as we are providing 1500 rupees off on the course. So let us understand what the recent news is. The central government has decided that it will not extend the deadline for payment of equalization levy by non-resident e-commerce players. The equalization levy is aimed at taxing foreign companies which have a significant local client base in India but are billing them through their offshore units and effectively escaping the country's tax system. The levy has relevance with the increased focus on digitalization and thus the tax losses which are happening for the government. Also, the step has come in the background of the United States Trade Representative investigation into taxes adopted or are under consideration by 10 nations, which includes India. So about the equalization levy, it was introduced in India in 2016 and it is similar to the Google tax which was brought in by the UK government. So the important instance was that Google's non-payment of tax in UK despite its huge revenue. So Google made around $5.6 billion of revenue in UK during the 2015, but it paid a corporation tax of just 20.4 million. This reduced tax payment as source and it was made possible as Google in record created nearly all of its profits in Ireland. At the same time, the company didn't pay much tax in Ireland as Ireland gave a favorable tax treatment to the company. Most of the money from UK was shifted to Google Ireland Holdings, which is a Dublin registered company but located in Bermuda for tax purposes. Several US technology companies including Apple, Microsoft and Facebook use the double Irish structures to avoid taxes in the UK. It was UK who introduced the diverted profits tax or the DPT in the year 2015 to tackle shifting of profits by big tech companies to tax havens. Since the law emerged to tackle Google, the tax is nicknamed as Google tax. The DPT was introduced in the background of concerns that Google parent Alphabet and other global tech companies were avoiding local corporate taxes by stashing their profits offshore. It was intended to apply to large multinational enterprises with business activities in the UK who enter into contrived arrangements to divert profits from the UK to tax havens by avoiding the UK taxes. The DPT as a new tax was set at a rate of 25% to divert profits relating to the company's UK activity. So accordingly, India introduced the equalization levy in budget of 2016 which had a provision included tax on payments for digital ad services by non-resident companies. The levy was applicable in case the amount exceeded rupees 1 lakh in a year and the tax rate was fixed at 6% and it was applicable only in the case of B2B transactions. But it was later extended to e-commerce companies in the budget 2020. In order to tap tax on income accruing to foreign e-commerce companies from India, the budget 2016 instructed that online advertisement payment exceeding rupees 1 lakh a year to a non-resident who does not have a permanent establishment will be taxed at 6% of the gross amount paid as equalization levy. And the extension of equalization levy to e-commerce companies was made in the budget 2020. The applicable tax amount is 2% plus a surcharge on amount of consideration received or receivable by e-commerce operator which has come into effect from 1st of April. So what does the term e-commerce mean? The term e-commerce operator means that it is a non-resident who owns, operates or manages a digital or electronic facility or platform for the online sale of goods or online provision of services or both. The levy will be paid by the e-commerce operator for quarter of the financial year by 7 days from the end of the quarter except in case of the last quarter. This means that the due date for the April and June quarter would be July 7th, while for the July to September quarter would be October 7th, and for the October to December quarter would be January 7th. But the present guidelines say that the levy will not be applicable for any e-commerce operator with a permanent establishment in India. And also, An e-commerce operator with an annual turnover of up to rupees 2 crores is not required to pay the levy. Also, changes have been made in the challan. The Income Tax Department has modified the challan number ITNS 285, which relates to the payment of equalization levy to enable payment of the first installment by non-resident e-commerce operators. The challan also seeks mandatory PAN and provides for outside India option while seeking address. The penalties involved include the non-payment, which is equivalent to a penalty of the amount of equalization levy along with interest. However, in case of late payment, it would attract an interest of 1% per month or part of the month. So, as India is racing to become a digital giant, the new tax needs to be implemented thoroughly, and further, there needs to be an international consensus on taxation related to the digital economy. So, before ending this lecture, I would like to tell you that Educate 247 brings you a comprehensive course for RBI Grade B 2020, which covers economic and social issues, finance and management, along with a comprehensive coverage of current affairs. To log on to the website and avail the benefits of the full video course today. Thank you and happy learning.